Hi, everyone, and welcome to The Breakouts, a podcast where we interview extraordinary founders in just under 20 minutes. I'm your host, Akkshay Khosla. Now, you'll find many podcasts out there that are 2 to 3 hours long and interview these wildly successful founders after they've already made it big. But by that point, the founders are already 5, 10, or even 15 years into their journey, so their insights just aren't as actionable anymore. We're doing things a little bit different. We're interviewing founders that are on the cusp of breaking out so that you can learn the playbooks they're using to build category-defining companies today. And we're doing it in just under 20 minutes. Now, just before we get started, go ahead and follow us on Twitter at The Breakouts Pod, subscribe to this YouTube channel, and join our Discord community for aspiring founders. The link is in the description below. And I think that's everything I have for you. So without further ado, here's today's guest. All right, ladies and gentlemen, today we have a phenomenal guest for you who recently raised a 5.8 million seed round at the intersection of PropTech and FinTech. It's an absolute pleasure to have Michael Gifford, the co-founder and CEO of Splitero, on the pod. Michael, how are you doing today?
I'm doing well. Thank you for having me.
Yeah, it's my pleasure. So Michael, let's get straight into it. Now, as you know, we do 2 episodes per guest. This first episode, we are going to be focused on the story behind your startup. So really that boils down into 3 things, how your startup came about, how it works, and how you think about winning the industry. So to get us started off, in just a few sentences, why don't you describe a little bit more about what your startup does and what problem you guys are trying to solve?
Yeah, certainly. Thank you for that. Our startup at Splitero, we help homeowners access the equity in their home without new debt or additional monthly payments. We really came about because there's tens of millions of homeowners that have a ton of equity in their home, but can't use traditional financial products.
Very interesting. Just so I understand this properly, the concept is that, hey, you give up an equity of the future appreciation of your home and you get money now today. Is that correct?
That's correct. Yeah, we give a homeowner a lump sum of cash, and then we ride the appreciation or depreciation of their home with it.
Very cool. And what would be some cases in which people would want that lump sum upfront? What would they do with that lump sum?
Yeah, certainly. A lot of our homeowners use it to pay off debt, have their savings. They use it to renovate their property, repair the homes that they're in. And they also right now, especially with the uncertainty of the economy, are using it to pad their savings, take some of the cash from their well-earned investment off the market.
That's very cool. I'm curious, Michael, what is your personal background? What were you doing before the startup, and how did your personal journey lead to you starting Splitero?
Certainly. I've been in residential investment for the last 13 years of my career. I've acquired over 1,000 houses, originated $250 million of debt, but really throughout my journey, I've been working directly with homeowners in all different markets across the US. And as we were seeing over the last couple of years, equity rising in people's homes, the values were increasing, but there's still a major lack of supply in nearly every market in the US. And so there's just a problem that was happening where people would own a home, it would increase in value, they couldn't access the equity, so they would end up selling that home or using a credit card, which are just not great scenarios. So I thought there had to be a better way. We started Splitero to help people with that so they don't have to sell, move out of the communities that they built their friends and family in, and they're able to access some of that home equity quickly and easily.
That's very interesting. I'm curious, is there one specific beachhead audience that you guys have?
There's really not. So we actually span the whole spectrum of homeowners from, say, someone that has financial distress to really someone with great credit option. They're not looking to take out a HELOC or refi their mortgage right now. Whereas with the interest rate environment where it's at, a lot of people have a great mortgage at 3.5% rate. They don't want to refi to a 6 to get some of the cash out, and or they're shopping for cash flow. We offer a lump sum of cash without a monthly payment on it. So nobody has to then say, pay a high HELOC rate pricing every month.
Very cool. I'm trying to dissect this into kind of a couple of different customer segments. You talked about, one reason for people wanting a lump sum upfront might be other bills that they need to pay. And another possibility could be that, hey, people want this lump sum to go and reinvest, right? Make their money work more for them. So these 2 segments that we're identifying here, the first segment, if we think about it, is it correct to say that the first segment might be people that are, have a home, but have some level of financial struggles. And the other segment is people that are incredibly financially savvy, who are looking to get that lump sum up front to invest in other areas. Or is there something I'm missing?
Now, we work with homeowners in both segments. For the former group that you mentioned, they might have a home with a lot of equity, but they don't have, say, other diversified investments. They might have debt for whatever reason, student loans. Again, with inflation going on, cost of living is certainly going up. So people need help on that side of things. On the other end, we definitely work with homeowners that are considered financially savvy. They will diversify their investment, maybe use the funds to purchase another home or invest somewhere else. So we work with that full spectrum.
That's awesome. Very cool. In terms of what your product does, I think one way of understanding it is potentially even looking at what is the competitive landscape and how you guys are different. Who are some competitors that you might list?
Yeah, certainly. There are a handful of competitors that offer home equity investments. I would say that they're all unique in their approach, and we certainly have our unique approach as well. But really, we compete outside of the home equity investment space as well. So even with traditional refinance and mortgage options, home equity line of credit, and frankly, we even compete with home sales. Some homeowners may elect to use our product instead of actually selling their home, moving to a new place.
That's very interesting. How would that work? Could you describe that a little further?
Yeah, a lot of homeowners end up selling their home because they need to access that equity. They don't have other routes. By us being able to provide them a lump sum of cash quickly and easily, they don't actually have to sell that house. Where the real estate market is right now, it's really tough to buy and let alone rent. And so a lot of people will sell needing to access that equity, but then it's a big question mark. Where do they go next? It's difficult to buy. They're typically priced out of the community that they lived in. It's also difficult to rent and very expensive to do so. So they don't really have good options on either side.
That's super interesting. I'm curious, how do you guys make money? What's your business model?
Yeah, certainly. So we charge the homeowner a small origination fee when we originate a home equity investment for them. We then ride that appreciation with them. So when they sell down the road, any time between now and 30 years from now, we realize a return on our investment as well.
Gotcha. So when you share in that appreciation, what does that exactly mean? Is there a certain percentage that you get, a certain percentage the homeowner keeps?
Yeah, certainly. It's part of programmatic underwriting. So each homeowner is different. But think about it as in terms of we will get a value of the house. We'll take a slight discount on that house. And that's our starting point. We share in the appreciation or depreciation of that home above and below that starting point. Because we apply a slight discount to the value of the property, we also provide a safety cap for the homeowner. The safety cap really limits the return on investment. So say the home increases in value significantly, the homeowner knows that their safety cap would be the max that they ever would pay.
That makes sense. So I'm curious, just so we can walk the listeners through this, and honestly, me as well, just as I grasp this concept. Let's say that someone has a $1 million house that they bought. What lump sum are they getting? Are they getting like $10,000? Are they getting $100,000? In terms of their appreciation, are they keeping 50% of the appreciation? Is it 90% of the appreciation? Could you walk us through some rough math here?
Yeah, sir. And every use case is particular to the homeowner and their situation. So for that $1 million house, the most that we would ever give would be 30% of that home's value. So that could be $300,000 in this case. It also depends on other qualifications of that property. We underwrite the whole portion, not just the lump sum of cash that they're receiving. So it depends what their debt is on the property. Maybe it's free and clear, maybe it's not. If they have debt on it, we can only go up to say 85% of that home's value. So it's really difficult to actually just go through math for say single use case. We have provided a calculator on our website. So homeowners can play with not only value their property, but also the length of ownership, which will affect how much they pay, as well as appreciation scenarios. So say a high appreciation scenario, no appreciation, or maybe even a depreciation scenario.
So when you're offering this package to a homeowner, are you providing them multiple options, or is there one suggested option for them to take?
Yeah, certainly. So how it typically works is a homeowner will come to us and say, hey, I would like X amount of cash, $100,000, whatever that may be. We will go through and start underwriting that homeowner and their property based on that amount. When we've completed our underwriting, then we can see the full spectrum. So say it could be that $100,000, but maybe they're approved for up to $250,000. We show them the whole array of it. And so then they could say, great, I'll keep my 100,000, or maybe give me the most that I'm qualified for. Let's see the terms on that. We show them all.
That's really interesting. Now, correct me if I'm wrong here, but did you just say that if someone has $1 million home, that they might be able to get up to $300,000 up front? Or is that 300,000 limit on a higher value home? Like, for example, a $10 million home?
No, certainly. So that is correct. They could get up to 30% of their home's value. Our average homeowner, he takes out about $150,000 of their home equity when they work with us, but we can go all the way up to 500,000. Some homeowners have actually accessed that amount in a lump sum.
And when people are taking out a percentage of their equity, right? Is it equity in the home's appreciation, or is it equity in the home itself?
Yeah, certainly. So we ride appreciation with them. So we take a portion of that appreciation, not equity in the house itself.
Gotcha. I'm guessing for you guys to be able to do this effectively, it probably takes a lot of acumen on both the financial side and the property side to understand what you can offer each homeowner based off of where they live, what are the value of homes there, how are they going to appreciate, right?
That is correct. Yeah. So we have a large bench of sophisticated real estate and financial professionals that help homeowners. And really, they're able to dissect all the options available for a homeowner and offer them the best product possible.
That's phenomenal. And you personally, it seems like you have a pretty phenomenal track record in the space as well. So it seems like just your kind of gig.
Yeah, certainly. It's one of my passions, make sure that homeowners have and do receive the best treatment. We're not going to be the right answer for every homeowner. We are certainly for a lot of them, but we want to tell them if we're not and educate them on what is a better option if there's one available.
Very cool. Now, if you're open to sharing, how many customers do you currently serve?
Certainly. We have served, so we just started home equity investments in March, and we've served hundreds of homeowners throughout California.
That is amazing. Just in a matter of a few months, 100 homeowners. I'm curious, when you're serving these homeowners, what kind of property values are you typically getting? Is there like an average property value? I'm guessing if it's California, property values are probably kind of high, right?
Yeah, certainly. And I said hundreds, so we are actually moving.
Hundreds. Oh, wow.
Yeah.
Wow.
Yeah.
All right.
Have helped homeowners. And yeah, so we are only in California right now. I would say on average, the home price is right around 800,000 or so. With that said, we've seen stuff into the multi-million dollars as well.
That's phenomenal. That's really interesting. And you guys recently raised a seed round, right? So I'm guessing you used some of that traction to raise this round of funding.
We did, certainly. So we raised our seed round, and then we also raised over $1 billion to help homeowners. So we have a lot of capital that is ready to be deployed to help homeowners access their equity.
Ah, that's interesting. So that is something I did not find in my research. Really interesting. Let's talk about that a little bit and unpack it. I'm curious. So this $1 billion of financing, right? $1 billion is a big number, especially for a company that's early, a few months or a year old. So I'm curious, what was the reasoning behind raising that amount of funding? And how did you go about doing it? I feel like so many founders are just unaware of how they can go and raise debt.
Yeah, certainly. About $28 trillion of home equity that's pent up right now in the US. And so there is a lot of appetite in the capital markets, the institutional markets to help homeowners access that equity. I think they see it really similar to how we do. There's not a major influx of supply hitting any of these markets. And so there's a major problem with all this equity that's trapped that's really not, that homeowners are really not able to attain at this point.
Interesting. So when you go about raising this debt financing, right? Do you go to banks? Do you go to individuals? How do you go about this?
Yeah, certainly. It's all institutional partners. So large institutions that are interested in helping homeowners access their equity. And we go about it really with the same kind of problem. There is a problem here where we have millions and millions of homeowners that are left behind by our traditional financial institutions. And so they want to step in and help. We're the conduit to help that.
That makes sense. That's very cool. So you've raised 5.8 million for your seed and you've raised $1 billion in debt financing. Amazing traction to date. Let's shift gears a little bit and talk about your competitive advantage and how you think about competition in your market, right? Every founder that enters one of these emerging verticals like prop tech probably has on their mind that, hey, how am I going to beat out the competition? How am I going to win? It's part of their strategy. I'm curious, how do you think about winning? How do you think about breaking out from the noise?
Yeah, certainly. I think that more so than breaking out from the noise is really just our core competency. My co-founder and I have been working with this consumer set for over a decade now, right? So we know what they respond well to, how we can talk to them, how we can help them, present options to them. And so really homeowners come to us and they understand how we talk. We might phrase things differently. Our brand probably appears differently than most. We're not a bank. We shouldn't look like a bank. We don't talk like a bank. And really, I think that resonates well with homeowners. But us being able to get into their shoes and understand the situation that they're in, that is at the end of the day, one of our strengths. And that's why we do hire all of our employees come in with a lot of real estate and financial background so they can sit with a homeowner, understand the situation that they're in, and then offer a solution.
Very cool. So if you had to articulate your competitive advantage into one or two main points, would the main point be that you guys are just very experienced in this place, which most prop tech founders do not have? Is that your number one competitive advantage, or how do you think about it?
Certainly, I think that's one of them, which really that is equivalent to being able to maybe convert at a higher rate if you had to describe it as a competitive advantage, right? So if we can target homeowners and convert at a higher rate, then that's a competitive advantage. I think that boils through into, say, different product features that we have that others might not, and really the capital that we're supported by to solve this problem.
That's awesome. Now, talking just a little bit about the larger prop tech industry, right? I'm curious, in your decade of experience here, what do you think, if you had to choose one insight about the prop tech industry that you think most people are not familiar with, what would you say that is?
That's a difficult question because I feel like there are a lot of amazing founders that are solving different problems. I think that prop tech in general is searching to solve antiquated systems within the real estate industry. And I think that overall, maybe the biggest problem that everybody is trying to solve is really velocity. Most real estate transactions take a long time, which for our homeowner subset could be very difficult for them, right? They are trying to access funds usually quickly to help some other pain in their life and really to make their lives and their financial freedom better. And so velocity is probably one of the biggest issues that I think that most people are trying to solve.
I think you articulated that really well. It seems like for each of these verticals that are still somewhat ancient and founders are trying to currently modernize and bring digital capabilities to, there's usually one major bottleneck, right? It seems like here in prop tech, you're talking about velocity. We can see parallels in other industries as well. For example, health tech, one of the biggest challenges there is acquisition, distribution. How do you achieve a quick sales motion when all of your sales are top down? And I think it's really interesting to compare and contrast these and understand what is the big bottleneck to solve in each of these emerging verticals, as I like to call them.
Yeah, definitely. I think probably if you look at prop tech in general, there are a lot of different groups that are trying to solve, say, the title industry, which is something that all of us have to deal with. When we go and underwrite a homeowner that comes to us, we immediately start a title search on the property, and that's a lengthy process. And so that is probably one of the biggest bottlenecks in this industry.
That's fascinating. Wow. Okay. So, Michael, we're coming up on just about time here. So as we wrap up this episode, first off, I wanted to say you have been phenomenal. Honestly, one of our best guests so far. It is an absolute pleasure to have you on the pod. I wanted to ask, as we wrap up here, is there anything you'd like to plug? Given that you raised recently, are you hiring? Anything, feel free. The stage is yours.
Yeah, certainly. We are hiring. We are hiring and expanding to other states very soon. But mostly we are on a mission to help homeowners access equity in their home by giving them a product without monthly payments or additional debt. They can go to Splitero.com, play with the calculator, reach out to schedule a call or speak with one of our homeowner advisors to go through the options for their property.
Awesome. Thank you for sharing that with our listeners. Now, last thing as we wrap up, if our listeners want to connect with you, where's the best place to do that? Should they follow you on LinkedIn, Twitter? What works best for you?
Yeah, certainly. They can go to Splitero.com to our website. You can find me on LinkedIn and on Twitter for sure. And Splitero.com is really the easiest to get connected with us. They can reach out, talk to one of our homeowner advisors about their situation.
Awesome. Thank you so much. I think that wraps up the episode, folks. Thank you, Michael. You were phenomenal. To our audience and everyone listening, we'll see you next time on the breakouts. Thank you, everyone.
Thank you.
All right, and that wraps up today's episode. We really hope you enjoyed it. Now, just before I let you go, I wanted to reiterate one thing. We're trying to build the best podcast out there for aspiring entrepreneurs, and to do that, we need your help. The best way you can help us is by joining our Discord community. The link is in the description below, and then leaving us feedback. Tell us how we did. Tell us how we can improve. We're eagerly waiting to hear from you. Other than that, show us some love and follow us on Twitter at The Breakouts Pod. And I think that's everything I have for you. We'll see you next time on The Breakouts.